Hello, my name is Joe Hoyle, and I'm speaking to you from the University of Richmond, and you're working on Financial Accounting Chapter number 3. And we're looking today at a company's income statement. We want to see how their financial statements are produced. So you have information here that comes from the Ace Donut Company, and you've been asked to make an income statement, then we'll make a statement of retained earnings, and then we'll make a balance sheet. Now, I'm not terribly interested right yet in what these accounts exactly mean. What I'm looking for here is the structure of the financial statements. I want you to feel comfortable about what goes on an income statement, what goes on a statement of retained earnings, and what goes on a balance sheet, and what each of those statements looks like. So we'll start today with an income statement. Now, an income statement will begin with revenue. And how does a donut shop make revenue? Of course, they have sales of donuts. So this indicates that in this year, this company had sales of donuts of 300,000. So we'll come over here and indicate 300,000 in sales. You're beginning to convey information to decision makers. We're now going to list the expenses of this company. Expenses are anything that takes or reduces their net assets in hopes of generating revenue. And if you take a look, they have rent expense, they rent a building or something. They have salary expense, they're paying that to their employees. And they have cost of goods sold, which is the cost of the donuts they sell to their customers. So in this little problem, we have first off, cost of goods sold, the cost of the donuts that they sold to the customers. And as you can see, that's $100,000. We'll indent this a little bit so we can have a subtotal. They also, as you know, have rent expense. They've rented a building or they've rented a truck or something that they can use in their business, and the rent expense is $40,000. And finally, they have salary expense of $60,000. That's apparently the amount that the employees of this company have earned, $60,000. So this company has total expenses of $200,000. You have revenues of $300,000 and total expenses of $200,000. And you can see the income statement is beginning to convey information about the operations of this business. If you take your revenue minus your expenses, you have operating income. And operating income is the amount that you made off of your primary business. And for Ace Donut, that primary business, of course, is selling donuts. And that business made $100,000 as their business income from the donuts. You also have things that are other than the primary business. In the textbook, we refer to those sometimes as tangential. They're part of the business, but they're not part of the everyday primary business. In this case, if you look through the account balances and come down here, you'll find that they have a gain on selling equipment. They are a donut company. The sale of equipment is something not part of the donuts, it's indirectly related. So we put down under other that gain on sale of equipment, and that gives them then, you can see the gain on equipment is $30,000. So that gives them income before they have to take their income taxes out. Income taxes do not generate revenue, they're required by the government. So when we come down here to the bottom, we'll have income before income taxes of $130,000, and then we will subtract out the income taxes that they have incurred this year. If you look at your account balances, right there's the income taxes. It says that number is $20,000. If your income before income taxes is $130,000, and the income tax figure that you pay the government is $20,000, that leaves you with net income. The increase in the net assets of the business for this year from being a business of $110,000. $110,000. That's your net income. This is your very first financial statement. The income statement is always done first. So we put our revenues, we put our expenses, we put our other things that aren't part of revenues and expenses, and then we subtract our income taxes. You can do that. This is what companies do. Now, you'll find different forms and different formats. The basic idea, revenues minus expenses, get operating income, figure in the other items, and then subtract out your income taxes, and you have that well-known number of net income. Now that we have done the income statement, let's go and do the statement of retained earnings. We're going to take the same numbers we had before. These are all the account balances of Ace Donut Company, but this time we're going to do a statement of retained earnings. Before we do that, what is the purpose of the retained earnings? Retained earnings is a measure of all the net assets that have come into your business from being a business. It's the net income from the very first time that you began, less all the dividends you've ever distributed. That's the measure of retained earnings. So we'll start by doing all the past years first. And you can see there that the retained earnings for the past years, retained earnings as of last year, year 9, 12, retained earnings 12, 31, year 9 was $300,000. What does that number indicate? That number indicates that all the net income they've ever earned in past years, less all the dividends they've ever distributed in the past years, equals $300,000. We're then going to factor in what happened this year. If you go back to the income statement, the net income that we reported on the income statement, the increase in net assets for this year was $110,000. Revenues minus expenses, gains and losses and income taxes, 110,000. But this company distributed some of those profits to the owners. They have a dividends distributed balance, and if you look over here, the dividends distributed is $10,000. So this company gave its ownership $10,000 because the company had been profitable. So the increase in net assets for this year is not 110,000, but 110,000 minus 10,000, the company got from being a business $100,000 bigger. If your beginning retained earnings for the year from previous years is 300,000, and if your income minus dividends for the current year is 100,000, as of the end of the year, you will have retained earnings. And this is retained earnings 12/31 year 10 for all operations that you've ever done of 400,000. We'll carry that number over to the balance sheet and we'll use it when we produce the stockholders equity section of the balance sheet. And finally, we're going to do a balance sheet. We've done the income statement, we've done the statement of retained earnings. Let's do the balance sheet. The first thing that you have on a balance sheet are your assets. And we're going to divide those up today by current assets and non-current assets. A current asset is something that will normally be used up in 1 year. Here they have 3 current assets. If you take a chance to look, they have cash of $220,000. They have accounts receivable of $90,000, and they have inventory, I guess that's donuts, of $40,000. So their current assets would be cash, $20,000. The company has accounts receivable. I'm going to abbreviate this a little bit because you know that that's going to be accounts receivable of $90,000, and they have inventory. That's the sugar and the milk and such they put into the donuts, and that's going to be $40,000. So this company, as of 12/31 year 10, will have $150,000 in current assets. You're reporting on that particular day. Next, we'll report the non-current assets. Anything that will exist or stay in the company for over 1 year. And they only have one because we kind of merged those two together. So we have buildings and equipment. Now you'll notice that buildings and equipment mentions that it's net. We'll talk about that net number in a later chapter. I just want to put it in there because it is correct to have the number as a net number. They have $600,000 in buildings and equipment. This company has total assets of $750,000. The assets being the things of probable future economic benefit. Next, let's report our liabilities and the stockholders' equity section. We'll do current liabilities first. Current liabilities are debts that you're likely to pay within 1 year. I've got two things that look like they're probably current liabilities. You have a salary payable, you owe your employees $20,000, and there's also a rent payable, you owe the rent of $10,000. So we'll list our two current liabilities. Salary payable. First thing is salary payable is $20,000. And then we'll list our rent payable, and the rent payable is $10,000. So you have total current liabilities, things that have to be paid within 1 year, of $30,000. That's very interesting information for decision makers. They have one non-current liability. A non-current liability is something that will be paid outside of 1 year, and you can see this note payable due in year 15 is non-current. So note payable, non-current, payable in year 15 is $120,000. This company, therefore, has total liabilities of $150,000. Now, it's important to notice they've got $750,000 in assets. They've got $150,000 in liabilities. The difference in those two numbers is $600,000. Where did they get the $600,000? So what we're going to do now, and I'm going to have to squeeze this a little bit, we're going to include our stockholders' equity section, and that's going to show us where we got the $600,000 in net assets. The $750,000 less the $150,000. You get that from two places. One is you can get it from the owners, and we'll label that as capital stock, or we'll label it as contributed capital. Here we use the term capital stock, and that's $200,000. So of your net assets, $200,000 came from the owners, and then you will list your retained earnings. And retained earnings is the total amount of net assets that came from being in business for the whole time you've been in business. If you go back to the statement of retained earnings, that final number was 400,000. 200,000 came from the owners. 400,000 came from being in business. That total stockholders' equity is 600,000. And it does explain exactly how you got 750,000 in assets and 150,000 in liabilities, or net assets of 600,000. 200,000 from the owners, 400,000 retained earnings, the net assets from being in business, which is net income minus dividend, the total $750,000. Does the balance sheet balance? Of course. 750,000 assets equals 150,000, 600,000, 750,000. I'm interested here in your making sure that you see what goes on each financial statement. I just want you to have a feel for the structure and content of the income statement, statement of retained earnings, and the balance sheet.